This program is live. You can call the program whenever you'd like. We're experiencing the same news events you are, and we're seeing them unfold as you are and trying to figure out, what does this all mean? What does this mean to our economy? What does it mean to those of you that are actively investing or even making trades and trying to figure out which direction to go? You can call the program whenever you'd like. Join us. You can text us as well at 979-596-6639. To make that easy, it's 979-59-MONEY. Jeremiah Bates, I'm Brian Wiley. You can go to therealmoneypros.com. You can also give us information there. You can feedback. You can ask questions. We will answer them. And if you allow us to read it on the air, we will do that as well. So same thing with the text, by the way. You can text the program. We just figured this one out. So like today, we just figured out maybe 10 minutes ago that we can actually have our listeners text in. Did you know that before, Jeremiah?
I did not until I saw this little number that popped up through our login flow, and I'm like, "What's that?" And clicked down. I'm like, "Wow, we got text messages," which is really cool because we've been talking about having that ability. Like, it's funny because we host radio shows, and I've called in to talk radio shows from time to time, but I generally steer away from it because I don't know. I'm nervous for whatever reason to call a radio show, and I think that's for a lot of people. So that's why I really like having that text feature where you can send in. We used to have the Ask the Experts feature on our website. Obviously, we updated that, but yeah, text lines are open. So if you want to send a quick text, we've got a few that have come through. One about selling a business, so we can talk about that. Brian, you mentioned plenty of happenings that are taking place in the news, the headlines. However, it has been the same news over the past few weeks. But, let's get into how the market's reacting, what you can do as an investor, how to view it, making sure that you're being strategic, not emotional. I think if there's one theme that we really lean on this show is best decisions are usually based on a strategy, something that's thought out based on a desired outcome versus points in time and headlines and sensationalism and uncertainty. Usually the best investment decisions are not made in that type of environment. So again, objective here is, let's talk about the reality of it. Let's talk about how the markets are reacting, but let's also talk about strategies that you can execute and have a better outcome, number one. And number two, making sure that you don't blow up your strategy. Take a deep breath. We've seen points of volatility in the past. We will see points of volatility in the future. We will likely see geopolitical conflicts in the future as well. So the key is, how do you view it with your overall strategy and making sure you're making the right moves?
Well, certainly not going to be any sort of an official poll, but we'd love to have your phone call. Let us know what you think is really happening in the Middle East and what the plan is. How do you feel about our leadership, and what do you think is going to be the ultimate outcome? I'd still like to hear what people have to say about that at 979-59-MONEY. That's 979-596-6639. So now let's talk about what's happening in the Middle East right now. It sounds like we've got Pete Hegseth, and they're starting to criticize the information that they have gotten from Netanyahu, looking like they were talked into this now. The Houthis have fired missiles toward Israel and claimed that, by the way, right out of Yemen. So, the risk of the regional war is coming true, which is a scary thought, because now when will it end? Here we are 4 weeks into this so-called very quick operation, and it sounds a lot like how Russia had said they're going to go in and take Ukraine. Now, maybe we were emboldened a little bit by what we did, taking Maduro out of Venezuela, but going in and trying to take over a nation that is clearly committed to protect whatever it is that they're protecting. And it's that mess right now, by the way. So what is it? Iran is now saying that they want to charge kind of like a toll booth to allow ships to go through the Strait of Hormuz, or which is now the Strait of Trump. I think that was a tweet that he sent. I wouldn't be too surprised if we saw that, because we got the Gulf of America. We do have President Trump that is now going to be signing. His signature is going to appear on paper currencies here soon. He's got his name on the public, all these different government, I guess, features like parks and things like that. And his birthday is free to visit, and so why not?
Yeah, why not? I mean,
Why not? I guess. All right. Phone lines are open. What do you think? I mean, the markets have been plummeting. So just yesterday alone, we saw the S&P 500 melt off about 1.7%. So it was a pretty big move. That taking a look at the broad markets. And then the NASDAQ, which is really going to focus on more growth type companies, think semiconductor companies, technology, but a lot of biotech in there as well. And the NASDAQ off by more than 2%. More speculation going on inside the NASDAQ. Of course, those people taking bigger gains and losses and expecting it, or those investors anyway. And then the Dow Jones Industrial Average down 1.75%. This is just yesterday heading into a weekend. And it kind of goes lock in step with what we were talking about last week, which is I said, be careful. If you're an active investor and you're trying to trade these markets, you must be very careful. And you might want to look at weekends as being a time that you just wait and see what the news does. But boy, volatility is the name of the game for this type of stuff.
Yeah, you hear this term volatility, and sometimes that can seem a bit vague. It's like, what does that actually mean? I think this week, and volatility isn't necessarily just to the downside, it's to the upside as well. And we've seen this. This has essentially been the reaction in the markets since this conflict came into play. Really, week over week, almost day over day, the markets are reacting based on commentary that's coming from our administration and President Trump. And we've seen big up days, really unwinding losses, maybe from some previous days or a couple days, because there's some optimism. Maybe there's some good news. We're seeing a trajectory towards maybe we'll find an end to this conflict faster than anticipated. But the problem now is that the markets are not as optimistic, clearly, that we're going to see a quick and speedy resolution to this. We've already passed the deadline. We have the NASDAQ and the Dow Jones Industrial Average as of Friday officially entering correction territory. And correction territory, there's these words that are then meant to, I think, invoke fear to an extent. A correction is basically a 10% pullback or more from the recent all-time high. So we saw the high in the NASDAQ, I think it was October of 2025. So based on the reaction of the markets that we've seen over the past few weeks, it is now more than 10% off of that all-time high. NASDAQ is officially in correction territory. Dow Jones Industrial Average hit correction territory as well. S&P 500, not there yet. I think it's about 9%, maybe 8.7% off of its all-time high. But again, we could enter in different risks. I mean, obviously, this is the conflict with Iran. That's the one's right in front of us. And I think a big part of this, too, is just not the equity markets acting alone in a vacuum. We're also seeing reactions in the bond market where we're seeing yields go up, particularly on the 10-year Treasury yield. And remember that teeter-totter that we've talked about when it comes to looking at bonds or anytime we talk about the fixed income market. If yields are up, it means prices are down. We've seen that happen with the 10-year Treasury yield spiking back up. And obviously the elephant in the room, oil. We're seeing oil back up over $110 a barrel, actually up over $112 a barrel. We're seeing energy markets react based on this. So you factor all this in, and it has a wave effect because now it's changing expectations from Wall Street standpoint, investors of where are interest rates going, where is inflation anticipated to go, and then how do these affect the bottom line profitability for all these companies that have been on a really good trajectory really over the past couple of years. So you factor all those components, and that is what equals your volatility, where we're going to have some big up days. And we saw it this past week where President Trump made some comments that it sounded like there was going to be some potential. And again, this was a couple weeks ago. New York Times, I believe it was, reported that Iran was looking for a ceasefire. Yeah, that wasn't the case. Markets were up. And then the next day, as soon as they debunked that, markets were down. Same playbook this week where commentary by President Trump made it seem that, there could be a resolution or some trend or some path towards a resolution. And then as soon as that was, maybe you want to call it being debunked, then the markets unwound again. And then we saw those back-to-back days of selling pressure, and that got us into the correction territory. So that's really what we're seeing in the market, trying to gauge. And you got to understand that the stock market is a discounting mechanism, meaning it's trying to value these positions, value these companies based on what the future earnings are anticipated to be. And sometimes when you have a conflict like this from the geopolitical standpoint, it's sell first, ask questions later. And I think there was some patience for the market overall. The question becomes, is that patience wearing thin? And what is the expectations for inflation, price of oil going up? We'd love to hear your thoughts. This is The Real Money Pros. We got to take a break. Phone lines are open, 979-59-MONEY. Stay with us. And we are back. This is The Real Money Pros. We are live. Phone lines are open. 979-59-MONEY. That is 979-596-6639. You can also send us a text message. Text lines are open as well. Again, 979-596-6639. Visit therealmoneypros.com. One of the best ways to interact with the show. You can get access to our podcasts, our educational videos and content that we try to update weekly. The objective of this show is not to sell you anything. We are fiduciary financial advisors. I am Jeremiah Bates. He is Brian Wiley. We practice with, our practice is real life people. Whether you're a business owner, you're approaching retirement, you're in retirement, you are focused on your family, and you have tangible targets that you want to achieve. And how do you make sure all that delayed gratification, doing all those right things, make sure that all of those things are coordinated to a plan, a strategy. And not everyone's strategy or plan is the same. Some people have different priorities versus other individuals. Had a great meeting this week with a client who they retired early. They were in a company that has seen significant growth. The company awarded them shares. So now they have a high degree of concentration in this stock, in this company that stock has grown over 300% over the past year. So they've done a great job in funding IRAs and 401ks and making sure that their cash flow and everything's in good order. But now they're at this point of feeling a little bit nervous of all this wealth that I've accumulated in this one company. But if I sell it, I'm going to run into an incredible tax bogey. How do I efficiently unwind this, better diversify, and make sure that these, my allocation, again, I don't like to use jargony terms, but again, how do I make sure that I adjust my allocation where it's not subject to a high degree of risk, meaning I have this bird in hand. We've all heard that cliche, bird in the hand worth two in the bush. So how do I take this delayed gratification and all these great gains and translate it into protection, into cash flow? And yeah, everyone's different to an extent, because I have some individuals that I work with that have various pensions and other retirement benefits, and maybe they annuitize an annuity. And how does this all factor into what you want to do? That's what we're here for. I'd like to consider Brian as like the puzzle master. So if you got various pieces, let's figure out how they all come together, and that puzzle's like very pretty at the end. One of the ones that you actually put that glue on the back and then frame it at the end of the day.
That's nice. That was a nice compliment too. Talk about the puzzle mastering part of it, and I've watched you just develop the best skill doing that. And it all goes down to being very thorough with somebody, because, for example, I got a text message from a friend, and I'm not his advisor. He doesn't have an advisor, and I could read this. Let me see if I could read it without. Yep, I can. He says he and his wife have roughly $390,000 in a CD, roughly $600,000 between them in retirement plans, and about $500,000 in home equity. They only owe $100,000 on their primary. They have no debt other than the mortgage, and they earn about $240,000 between the two of them. And I know that they've got two minor children. And he was just asking, he says, I feel like we're maybe making the biggest mistakes on tax decisions and missing things. And I have to agree with him on that one, which is you got to take a look at that. Now, his wife wants to invest the money. He's considering, he wants to buy another rental property. She wants to invest the money in the markets. And I would say hold off on that. Let's look at what you can save in just taxes alone. If you can save that money in the taxes, then we might be able to lighten up on how much risk you take on the investments, which is the part where he hesitates because he's thinking a rental property. And I look at it thinking, why would you want a rental property when you can earn the same amount or better? You can mess around with the taxes too in long-term holdings, long-term capital gains, and be able to make sure you're tax efficient on the investing. You don't have to fix a toilet. And so my point is they got to sit down and have a real thorough look at things. And that's the puzzle, that the whole puzzle has to come together to fit, because ultimately he's asking, how should we invest this money? Like, well, I don't know yet. right? I had another question just this morning. A friend of mine, he goes, how do I get started? And this is somebody that truly just needs to get started. And I said, I found this great app recently, and it was from a friend of mine that was showing me acorns. That's what it's called. Have you seen that one where it rounds up the dollar and out of your bank account? On every transaction, you always get a whole dollar amount because it takes all the pennies, the difference between the actual retail amount that you spent and that whole dollar, and it puts it into an investment account. And this gentleman, since 2020, had saved over $12,000 inside his Acorns account. He had no idea it had accumulated that much, and he had luckily selected some sort of a kind of a very diversified investment mix, and he did great in it. He had a couple grand in gains out of that 12,000. Like I told him, I said, that's how you get started. So mindlessly is do it that way. It's just like out of your retirement plan. And part of the puzzle sometimes is just trying to figure out where the corners are, right? And then you get the edges, and then we're going to try to fill in the middle. Can't stand the ocean scenes on photographs, though, and puzzles, stuff like that. Yeah.
But these are real life. To add on to that story that you had with a friend sending that text message, these are the decisions to make, and it's hard to look at these alone just in a vacuum where it's like, okay, I have this. It's like, well, we got to understand, I want to put the money in the market. Well, what does that actually mean, putting the money in the market? Is it because that you have a long timeline and this is money that you do not see yourself actually needing in the near future? Then we can look at, there are some options where it's not locked up from a standpoint where you're penalized of moving the money, but you are up against timing risks. And there's one really nice feature of the market. And again, I'll say this till the cows come home. Cliches are cliches for a reason. And this one I like. It's not timing the market.
Pardon the cliche on the cows come home. Go ahead.
Yeah. God, you caught that. It's not timing the market. It is time in the market. Case in point, you look at the S&P 500 last year, it was down more than 15% at one point. And then if we looked at where the year finished, it was up more than double digits. And I think the big takeaway on that is in light of volatility, or in light of a big sell-off or officially entering correction territory like I talked about last segment, this is where you can really trip yourself up as an investor, where emotions start getting in the way. And you almost have to understand, like, this is a bit of a psychological game when you're talking about your money, because your money represents something. It represents your hard work. It represents your safety. It represents that boat that you want to buy. It represents that travel trailer, or, security for your kids or grandkids. And when you have that emotional tie to it, when you start to see red on the screen and you start to see these headlines that just really invoke doom and gloom, that psychological component's really going to start to kick in, and it's like that fight or flight. And there's plenty of studies on the psychology of money where your brain is actually feeling some type of existential, like something's coming to get you. And it's like, well, I just retired. I can't afford to lose anymore. That's where, again, that emotional piece, that emotional risk is very important to understand, where you could almost replace that with market risk in some cases. So the point being that when we see deep sell-offs, this market could turn really quick if we get some positive news. So if you're making adjustments out of fear and emotion, you could potentially miss that quick rebound. And you don't have to look far back in history, meaning last year, to see if you made those dramatic moves, you would have missed out on double-digit gains at the end of the year.
When you see market volatility like this, you also start to really pay attention to headlines. And this is when fear will sell annuities and things like that to people, where you think that's going to be the safest place. And then you lock in your losses, going to basically something that can never grow again. And then you're disappointed, because then the market will rebound. But it's a repeated thing. This is The Real Money Pros. We'll be right back.
You're listening to The Real Money Pros.
We are back. This is The Real Money Pros, therealmoneypros.com. That's how you find us. You can also call us or text us at 979-596-6639. We are sponsor supported. It's a live financial program. Jeremiah Bates is here. You're going to skip out for the next hour, though, right?
Yeah.
I'm solo. You just bought a house.
I did.
It's good stuff.
It is. Moving's not fun.
Are you guys posting photos all over social media so some minor children out there can be glued to what you guys are posting in the brand new home, and they lose their...
My wife is the social media I'm not
She
a
is.
social media user. I'm just not. I mean, the only like Twitter a little bit. I don't use it to post. It's really more of just a feed of
Same.
news. I mean, that's really all
Yep.
it's for. And then Facebook Marketplace. That's probably where I waste a majority of time of just looking at items. I'm like, wow, that's a good deal, which I'm never gonna get it. But I've also, you know me, Brian, better than anyone. I get a lot of pride in paying deep discounts on quality items. So I spend a lot of time on Facebook Marketplace. But as far as the like the Instagram and things like that, my wife does a little bit of that. She enjoys it, but I'm just not a social media guy.
Giant landmark lawsuits out of New Mexico, giant awards being paid for that one. And this one is about whether or not these companies are disclosing and preying on young people. What are your thoughts on that? And I'm sure the news stories, we don't need to regurgitate the whole news story. I think most people have heard this story, but if you haven't, read about it. So what do you thought? What are your thoughts about this? Should they pay? Have they done something wrong?
Well,
It's
define
like
wrong.
the tobacco companies
Yeah.
knowing, they were adding things to make people more addicted, and advertising was definitely focused toward young people trying to get new smokers and getting them going. What do you think about social media companies? Are they guilty?
I do think you look at, and there's a lot of studies that have been put out there that significant use of social media, especially for the younger generation, clearly not good for their overall well-being. And I've fallen victim to this too. I mean, you just sometimes you waste some time on that. It's just you put your head down on that thing and you look up like TikTok. I will say can be a time suck. You could be a couple hours into that thing and you don't even know where time had went because it's just so good at those quick bites and that algorithm that just starts feeding what you want to see. But I do find it interesting. Like if you look at the fines on their own for Meta and Google, they were pennies in the grand scheme of things. I mean, damages totaled about $6 million. It was a little over $4 million for Meta, which is parent company of Facebook. Almost $2 million for Google. So from a dollar standpoint, as far as are these bad investments? Are these fines really going to hinder these companies' ability moving forward? Looking at that on its own, I would say no. But then the question really becomes, as an investor, does this set a legal precedent moving forward that could change the profitability trajectory for these social media companies that, it's huge for advertising. It's huge for engagement. I mean, these platforms have been extremely profitable over the past decade or more for these companies. So in my mind, the question really becomes, moving forward, does this become a tobacco-like moment where they do find that, hey, these companies did know the issues here. They did know that this was highly addictive. They did know that there was potential issues and could cause harm, and that the whole cascading effect. I think it's a little bit different because, I mean, tobacco, I think there was real tangible health, meaning you could easily take out. I mean, I'm not a doctor here, but I'm sure you could do. We've all seen the scans of a lung of someone who's used tobacco or smoking for a long time for someone who didn't. So clearly, there's health. So they had to do proper disclosures. They had to do a very big legal settlement. The question in my mind is, does that happen to the Facebooks, to the Instagrams, to the YouTube? I mean, there's this precedent set, or is it just, hey, you need to properly disclose, or there's age limits, or there's more steps for verification to get there? It's just so unknown at this point, in my opinion. But if there is a precedent set and there's going to be significant legal ramifications for these companies, then I wouldn't be surprised to see some profitability hit to these companies. But it's just unknown at this point.
So Facebook, Meta platforms, and they get hit with this lawsuit. And, of course, they're going to take it to an appeals court, and we're going to see how this one goes. They'll probably take it all the way to the Supreme Court, be my guess on this one, to see if the financial injury is real, because they've got to protect it. It would shut down a company like this. The lawsuit that one plaintiff had gotten out of one state. Now imagine all the plaintiffs that would come through. And if they knew about it, I mean, go back, every generation has had this, where there's been corporate fraud. In the 70s, it could have been Ford and the Pinto. You had the Halliburton stuff. You've got the Monsanto stuff. You've got Enron. I mean, you just go through this, and we're always going to have this type of stuff going on. But how do you invest in it, or what do you do about it? I don't know. What are your thoughts? We'd like to hear. Do you think that these companies should be punished, or is this something where we've always looked at this as through generations, through the 70s and the 80s? Do you remember the stories about kids watching too much TV? They said it was going to cause blindness and screen time and everything. In the 90s, it was kids playing video games. In the 2000 first decade, now it's social media. I mean, we have these things that people do with their idle time. And this is kind of the way it goes.
Well, I mean, even going back real quick, Brian, to the tobacco analogy, it's like it didn't completely decimate that industry. I mean, even if you bought in at like the height right before that legal settlement, I mean, and you held on to now, I mean, look at your Philip Morris's, your Altria, I mean, ticker symbol MO. I mean, those have still been extremely profitable, right? So even if there is some shakeout to Meta and Google, some regulations, you could argue that those regulations might even make those companies stronger, but I don't think this is an industry collapse by any means, or might be the beginning of the end for these potential companies and social media use. People are too into it, and I don't think that trend is going to change.
The lawsuit money is baked into the price of the stock, too. So the rest of the scare is usually to people who are just now learning about it, and that's where that comes from. 979-59-MONEY is the phone line. Let's go to Mark calling out of Beverly Hills, California. Mark, thanks for calling the Real Money Pros.
Hi, Brian. Hi, Jeremiah. Great show.
Thank
Okay,
you.
here's my problem. I just retired, and, Roth conversions and things of that nature, Social Security, when to take it. These are questions that are heavy on my mind right now. So a lot of it has to do with tax optimization, obviously, with Roth conversions and taking Social Security. I'm asking my financial advisor at my big box firm all these questions, and they don't want to touch it. They keep palming me off to, hey, you should talk to your CPA. Is it time for me to start looking for another advisor? And if so, what types of questions do I ask the prospective new financial advisors?
Who wants to start on this one? Jeremiah, this is you
Brian,
teed it up. Thank you, Mark.
Brian, you go, and then I can add some color commentary.
Yeah, as a fiduciary, and more in light of the fact that as financial advisors, Jeremiah and I and our team, we commonly will take discretion, meaning we will actually take trading control, investment control of client accounts, which means to do this in your client's best interest means we've got to have a very close view on everything that we can discover about that household to make sure that things are appropriate. Well, along that time, this is the comment from Jeremiah earlier about the puzzle master, which is you've got to address taxes. And so taxes commonly is going to be done by a CPA or an EA, but we oftentimes go see them when they're too busy at tax time to actually have that planning meeting. And as financial advisors, we know the results of what happens to clients when they go to a CPA and they come back with these suggestions. And obviously we start to learn from that. Every financial advisor, in my opinion, should be doing a thorough look for every client that they are signing papers on saying that they're working as a fiduciary. So the answer is yes. I would look for somebody else. I would find somebody that is working as a fiduciary. The credentials might be a Series 65 or a CFP designation, but be, I guess, a little leery when they have their Series 6 or 7. That means that they're able to earn commissions on sales and insurance licenses. We gave up our licenses years ago. We're fully trained to be able to do insurance. We can give advice to clients on it. We just didn't want to have that conflict within our business, but I think we may change that and go back to that. But then look and see what the status is of all those licenses. Talk to friends. If you're looking for a great advisor, of course you are. We know plenty of them through Apollon Wealth Management, and that's part of our group. Jeremiah?
Yeah, I mean, to answer the question, I will give the advisor a benefit of the doubt. I probably do this to a fault up until the point where you can no longer do it. But, there is that compliance aspect of it too, because, you can't give that direct, do this from a tax standpoint because, you're not a tax professional. But in this case, like how I operate with clients, I need eyes on your tax return. I need to see it. And I I think a lot of advisors, really good, well-rounded advisors, are very tax savvy, meaning that a lot of times the investments to an extent should align to some extent for the tax planning and tax efficiencies. And that's where we talked about Roth conversions. That's where we talk about Social Security, because again, we got to understand if you make these movements, you don't want to make a move and then be really surprised from a tax standpoint. So what I like to say is, hey, we're going to dive into it. We're going to give the education. We're going to run projections so we feel really good. But when it comes to the execution of the tax return, actually getting it done, that's when you work with a CPA, an EA, or an actual tax professional. But 100%, find an advisor who's well-versed in taxes and can give you some good direction. This is The Real Money Pros. We'll be right back.
Pros.
We are back. This is The Real Money Pros, therealmoneypros.com, and that's how you find us. You can text us live on the program at 979-596-6639. Make that easy. It's 979-59-MONEY. Jeremiah Bates is here. I'm Brian Wiley. Mark, thanks for the call out of California. That was great. Beverly Hills, hello. And I know that we've got a new station in San Diego picking us up live today, which is welcome to The Real Money Pros. Now, a couple more things about the taxes, though. So I had read that text earlier from a buddy of mine, and I responded back to him, said, hey, let me just set you up with somebody in the office and have them come in because they're dealing with a substantial amount of money for a young couple. Now, I had asked, I said, are simple things. Have you funded up an HSA? And he goes, no, we have an HSA. We haven't funded it up. So it's the same thing you were just telling me over the break, Jeremiah, that you had the same thing going on. And the HSA, for those of you that don't know, on a federal level, this is money that goes in pre-tax, and if you use it for a qualified health care expense, then it's completely tax-free, which what happens in the middle? If you grow it, what means all that growth is never taxed. So it's the most tax-favorable account title you can get in the United States right now, period. And if you're not funding up your HSA, assuming you're eligible and you've got an eligible health care plan to go with it, well, then you're blowing it because we're talking about saving not only money in federal taxes, but also in state taxes if you live in a state that has an income tax. That's just easy pickings, right? So you're thinking, well, my advisor, of course, is going to know about that because it's also an investment account. Well, some states also offer what are known as medical savings accounts, which is perhaps the state will allow it to be tax deductible on the income tax of that state. Well, this is important for your advisor to understand all the benefits or all of the tax rules, or most of them anyhow, that are available to you in the state that you live in. Meaning we can't just keep doing this as just general rule of thought or rule of just rules to go by, because we've got to actually get down to the nitty gritty. When Mark was asking, should I find somebody new? And I think that the answer is you can mature out of your advisor. Your advisor may have been best used during the middle part of your relationship with the advisor, and you could have actually outgrown them. It's very common that they don't get the sophistication because maybe they don't have a lot of clients that will continue to accumulate assets like this.
No, it's well said. I mean, you could use the analogy from a financial planning standpoint. It's you're going to go climb a mountain, and sometimes you need a guide to climb that mountain. And depending on the difficulty of that mountain, meaning the elevation, are there different peaks, different valleys, sometimes or even like going down a river. Like if it's not a complex river, you could work with someone who maybe is a weekend to their river guide and you can make it down that safely. But if you're going down a treacherous descent, then you probably want someone who knows this, knows that. So it just kind of reiterates your point, Brian, that, yeah, you need to make sure of where you're at in your financial journey, that you're getting a level of sophistication that matches, what you have in front of you. And case in point, I met with a household where, a lot of moving parts, and there was a lot of things that were missing in that holistic advice that were just not even being looked at. And we found a bunch of stuff, but it's, to your point, oh yeah, by the way, you are HSA eligible. They assumed that they could not put money into an HSA. They were wrong. And just in doing that, the tax savings that would translate, literally just moving from one account to another, we're talking over $2,000 of tax savings, meaning it's just money that's kept in their pocket. So yeah, to Mark's point, you want to make sure that the advice you're getting from your advisor is coordinated with your CPA, or they're looking at tax saving efficiencies that'll certainly help you. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639. Let's go to the phones. We got Greg calling out of our home station, KBOI. Greg, what can we do for you?
Well, good morning. It's a world of acronyms. Team, together everybody achieves more. And then the other one is caveat emptor, buyer beware. But let me just make one more statement. I was in the industry for almost 35 years. And to borrow a saying from my good buddy, the plumber, Kenny, when you need an advisor bad, you need him great.
That's great. That's true. Kenny's one of the best businessmen I know and one of the most recognizable voices, too. Kenny's a great guy.
Yep.
But, good point.
But, the caveat emptor, buyer beware. I mean, I learned this back in economics in college, and it's something that I've never forgotten. And there's a scam a minute, I should say a scam a second going on. And, you really do need to trust advisors, but you need to find your advisors. You don't do your own surgery. You don't fill your own teeth. You don't test your own eyes. You've got to have somebody that's got their hands wrapped around it, understands you, communicates with you, and does what they're supposed to do as a fiduciary. And you know what? I'm going to say this. I've been in the business a long time. I forced to retire because of a serious accident that left me totally and permanently disabled. And you got to plan for that, because it can happen to you. It can happen at any time. You don't know the time, nor the place, nor the day, or anything else. So put your team together, but make sure you do your homework. But I will endorse these guys because I've been around the block. It's not my first rodeo. And I'll tell you, I tune in all the time to listen because I still can learn something.
That's great. Thank you. I appreciate that, Greg. And we're not allowed to ask for endorsements or anything like that, as you know, but you just gave that unsolicited. So thank you. Appreciate that very much. When you were in the business, I'm going to guess that it was probably in the 90s, and because you said 35 years of it, that's probably when you got the majority of you're probably mid-career then, right?
Well, yeah, I started in the 80s.
Okay.
Actually, was a cop and a fireman and ventured into the industry, and so I've done pretty well. But then I got whacked by a car in 2023, and that came to an end.
Well, I'm sorry about that. In 2023. So then, yeah, you were an advisor when the industry was making some rapid changes. So you had the whole boiler room thing. You had the tech boom and bust cycle. We had the penny stocks, the pump and dump strategies. There was just a lot of corruption in Wall Street. It seemed to it started to clean itself up. In probably about 2009, somewhere in there. It had to happen after the Great Recession. And then it just became complicated because of the fiduciary rules and the concern about what is a fiduciary and best interest rule, and a lot of fighting about that and liability. But really what it comes down to, Greg, is that the personality of your advisor has to fit with you. And it's got to be somebody that knows how to communicate with you. So the fact that I think I have the greatest advisor team here in our office is just the greatest advisors for some people, because you want this to be a long-term relationship. And thanks for the call. Certainly appreciate it. And we're glad you're listening too, by the way. And thanks for that endorsement. It's really nice. 979-59-MONEY. That's 979-596-6639. I can say this, is that when you are researching them, you should look at the record. So if you go to investor.gov, which is the SEC's website, you can go in there and type in Brian James Wiley. That's me. And you'll learn about my career and all the firms that I've worked with. And you're looking at disclosures. Is there a disclosure? Has a client sued me? Have I had complaints? Those will show up. Even if an arbitration panel had all agreed that nothing went wrong, it'll still show up. The trend is your friend. If you see a lot of red dots, then you probably have a problem there. But beyond that, it's just part of the way that this goes. You got to do your research. It's like doctors. They've all done the Hippocratic Oath, but some of them offer some pretty quirky services. It's odd. They're selling you vitamins on the way out, and there's a lot of conflict, it seems, and interest. But good advisors should understand the tax, the estate planning, the insurance world, to include obviously planning and investments, but understand the healthcare world and understanding how corporations are also working with people to try to help them save, and then be aware of what's going on economically. It's a business that, to me, when I first got in it, Jeremiah, I was afraid because there was so much to learn. But what I'd learned, and luckily I learned it pretty quickly, was really we are dealing with emotions. and then you can fit the technical sides into that. So doing radio and everything has helped because I've had a lot of questions. We've had a lot of interviews, experts. We've had a lot of meetings with clients. And so it does help us round out the knowledge. So I think people should seek a good, well-rounded fiduciary advisor with the plans of keeping them. So even if you're going to pay them a la carte each year for just an hourly service or a review, or if you're going to have them take full discretion and get a percentage of the total amount of assets that they're managing, then choose the right one. Jeremiah, you're out.
I'm out.
Okay, I've got the next hour. It's live. You can call the program whenever you'd like, therealmoneypros.com. Send me a message. You can text me as well. I can take phone calls, 979-59-MONEY. That's 979-596-6639. I love working with small business owners, too. I'll be right back.
Made simple.
Welcome back to the second hour of The Real Money Pros. This is The Real Money Pros. Jeremiah Bates is out. I'm Brian Wiley. I'm here in studio, live, ready to take your phone calls, your text messages. You can send me an email, Brian. I spelled it the right way, by the way, with an I. Brian at therealmoneypros.com. I probably won't check those during the program as much as I do the chat room and the text room or the texting, and I can see the phone calls coming in and put them on the air. So you just have to call the program. The emails take me a little bit more time to get into. What do you think about things right now? How are you feeling about the direction of what's going on in Iran? What do you think is going to be the ultimate, I guess, outcome? And what is the objective at this point? And I mean, it's just the data just changes daily, as you know. So we're watching this, and I'm just curious of how people feel about things. I'm thinking just better communication for the American public would probably be to our benefit. We could understand a little bit more what the objective is and get on the same page. Seems like the healthy thing to do. Or do you think that this is a boots on the ground type of a scenario where we've got to go in there and finish the job completely? 979-59-MONEY. That's 979-596-6639. I've got another question for you, too. Oftentimes I'll meet with folks that will tell me that their ultimate objective is to own their home free and clear. Do you use your mortgage as a tool, or do you see it as a burden that you must get rid of at some point and then own your home free and clear? How do you feel about that? If times change, 979-59-MONEY. Also have a text message. Now, this one we're a little late in getting back to. Actually, I'll read the second one. Might as well be later on that first one. It happened last week. This gentleman had, and I'm assuming it's a gentleman, he says, I'm interested in your opinion on the following. I'm retired, have a retirement plan that's fully on track, including short and midterm buckets. But thinking about the future and when I may not want to or be able to manage my long-term investments to fund my income. I'm evaluating a lifetime income annuity to handle that. Doing so would still leave funds for long-term investments. What are your thoughts? And he says, historically, I have not been a fan of annuities. He said the other option is to handle this future need for me could be obviously to do some sort of a managed account, but I don't like those costs. Okay. When you had said that you understood the short and midterm buckets, let me explain what that means to everybody else. So we're talking about our better buckets, which you can find at therealmoneypros.com. And the short-term bucket is meant to be cash, right? This is your money market accounts. It's something that is liquid to you. You can get that dollar the day you need the dollar. And when you're retired, you may have some Social Security income. You might have pension income. You might have business income, whatever it might be, but you also might have a shortfall every month. So if you received $4,000 from other resources during the month that is just always coming to you, kind of like a pension, maybe that's Social Security, well, then you may have a shortfall of a couple $1,000s to make your budget. So all that money times 36 is my recommendation. Our whole team, this is our methodology with the better buckets. That's the amount of money that should be represented in all of your investment and pool of funds that is available to you. It should be that amount. So in that case, 36 times 2,000 would be $72,000. We want that represented as cash that is not going to move with the markets, period. The middle bucket is to replenish that cash at the rate, in this case, of $2,000 a month or $24,000 a year, it needs to come from something. And here's how we determine how much money should go into that middle bucket. You divide that $72,000 by whatever expected rate of return you know that you can get as far as income goes from income paying investments, such as bonds that are repaying interest back to you or stocks that are paying dividends. It's got to be consistent income. And you divide that number. So let's say it's 72,000. I've got to pull up my calculator and see how quickly I can do this without making an error. So $24,000 per year is what we were saying on that assumption. 24,000. And I'm a little slow at getting this. Maybe I should use the keys. There we go. And we'll divide that by, let's say 0.06, 6% annualized income. And that number should come out to about $400,000. Did I get this right? Yep, I did. So that's how you determine how much money is going to be represented in that middle income bucket. Now you're thinking, well, my total retirement assets isn't much more than that. Then you're right. That's the way it goes. We're setting it up, the majority of it for income. The 3 years on that cash side for the money market or CDs that you have is there, and it's ready because you already know that you're going to use it, and then you're funding it and refunding it each year with the income that you get from the income account, and all the rest goes to the growth account. So now let's go back to this text. The text message says, manage his long-term investments to fund my income, meaning he's doing it basically on this thought that he's got a short term, he's got his midterm, and now he's saying that the rest of it is going to be long term. And my question on this one is, why would you use an annuity then? Because the annuity in essence is going to be treating it like it's current income. It's either going to be a combination of the middle bucket or the first bucket, but it's certainly not the growth bucket. The growth bucket needs to have exactly that criteria, which is whatever investments are inside that growth bucket, you're going to leave it alone. You've got to allow it to do its thing. And we've shown over any 10-year period, with one exception, I believe it was 2000 to 2010, that we did not see the general markets higher in that 10-year period. In every other 10-year period you can pick out over the last roughly 100 years, you will not find the markets not being higher in general. So if you use that, then we say, okay, the long-term bucket needs to be invested for 10 years. It's got to be out there. And you give it that time and allow it to do its thing. And you then, at the end of that 10 years, so as you're approaching the end of that 10 years, that might be the time you go out and start shopping for an annuitized policy. And if you think about this, the older you get, the better the income it's going to pay from that annuitized policy you went out there and shopped it. So giving yourself 10 more years to age is only going to make that policy probably pay you better. Then you can go out there and shop the markets then. But don't do it at the beginning. Do it at the end. In that case, phone lines are open, 979-59-MONEY. That's 979-596-6639. I have a caller named Eric on the line. Eric, what can I do for you?
Hey, brother. I was just curious, man. I've been thinking about this a long time. And I see, the richer get richer and the poor get poorer. But what is one thing that wealthy people are doing right now that's like the average person isn't even thinking about?
Oh, boy, that is such a great question. It's literally, you take what the person who never seems to have money and the person who does, the person who does has a strategy. They have a system. They repeat it. They're saving on a regular basis, and it's that commitment to it. Generally, this is as a financial advisor sitting in front of people who have made it and people who have not made it. The general trend is those people who did not have a plan did not make it. That's it. Okay, that sounds pretty vague, though, right? But it's not vague. Meaning,
100%.
Eric, if you are funding up, let's say, your retirement plan with, let's say, $50 a week, you're putting $50 a week into it, and you kind of set it, you forget it, you walk away from it. That's systematic. That is planning. That is something to get somebody started. And the reason why I was mentioning earlier this program called Acorns, where it takes and skims off the pennies and it puts it into a savings account, which you can invest. That is another great way to just get started. In the wealthy, the people who are getting wealthy are just doing the same thing. They're just doing it eventually with larger amounts of money, but it's being systematic about things and actually committing to it and just allow the plan to play out.
Got it. So it's like creating that duplicatable process and probably eliminating Netflix and eating out if I really truly want to, care about my my financial future and also the generational wealth I'm trying to leave my family.
Well, and think about it. When you're enticed to invest some money, and I don't know your investor experience, Eric, but when you're enticed to finally invest some money, it's probably because you've heard about it, read about it. There's something that got you interested in it, right?
For sure.
And then you want to dump a bunch of money into it. That means that it's been hyped up. And usually what I've noticed is that by the time it gets down to the everyday Joe or everyday Eric or the everyday Brian, it's old news, and the money that went in and actually made money on it is probably already exited. So what we want to do is actually set up a system where we know right now that investing in our markets, the stock markets here in the United States, is that you give them time and the trend generally up. Diversification is your friend, and boring is better in this case. It just is. It's not very fun. It's not very sexy to do it this way, but it works systematically.
Got it. So, got it. So I heard something about duplication, and then also catching a trend early would be a good thing to get money fast. But if you want it for long term, then it's going to be slow and lazy.
Well, what's one of the biggest headlines that is happening in the world right now as far as major changes goes to how society functions in the future? And it's AI. We're still at the beginning of the trend.
100%.
We don't fully understand all of the applications of it, but we do know that it's going to exist in no different than how we thought about the internet. I'm Brian Wiley. This is The Real Money Pros. Make this year that you work smarter, not harder. You can find us online at therealmoneypros.com. You can use the Ask the Experts feature on the front of the page, and that sends an email right to the team of fiduciaries that are a part of The Real Money Pros. It's free to you. We always respond, and you always get a fiduciary type of a response. Sometimes we'll say that we need to have a phone conversation, ask you more questions. Sometimes we can just answer your question, and a lot of times we'll even ask if we're allowed to read that question on the air. We don't just assume. We don't do it. We're not going to just go share all of anything about you, and we'll certainly never disclose who you are or give details of such. You can call the program again at 979-59-MONEY. You can also text the program. Sponsor supported. I'm not trying to sell you a thing, and it kind of gets me back into that last question, which was annuities. And I realize that I don't speak very kindly of them. I don't have a problem with them. I have a problem with how they're sold and who they're applied to. It can be a useful tool. I've not seen it very often, candidly, in my career where I felt that the annuity was the best route, but there can be some tax deferral advantages from it. I had a friend ask me, she's training right now for her insurance licenses, and she says, well, why don't people just buy universal life? And I said, okay, that's a perfect example of the people who are selling them and the financial incentive to sell them. You start with the annuity, which pays well, but then you just start to twist this over to the universal life part of it. I said, the problem with universal life, and she knows this, I said, is that you're telling people to take the money out as a loan, not pay income taxes on it, but by law, they have to pay some interest back into the policy. What happens when your policy runs out of money? She says, well, then it crashes. I said, and it creates a tax disaster. A modified endowment contract, a MEC is what it becomes known as if you had taken all of those loan dollars out. Let's say that you did over 20 years to help fund a shortfall in retirement, and you took out that money over 20 years and you ran out of money. Because also the policy is demanding interest on the prior loan. So those are starting to accumulate, snowball, if you will, as fees into the account. And then you run out of money. Then you get hit by the IRS with a giant tax bill as if you had taken all that money out in that final taxable year, which then runs you up through the federal marginal brackets, probably your state income tax brackets, meaning it can be an absolute disaster. Most of the insurance agents are also selling these things on the assumption that you're going to max fund the account. It's called, from what I recall, it's called the 7-pay test, and you will fund it to the max, meaning you're paying for the cost of insurance and these things, and then you're putting money into some sort of a variable or a general account that has paid interest. And all of the assumptions and illustrations seem to be run on the max funding, whereas most people don't sustain those type of payments into insurance policies. The other thing is you solve for the death benefit amount. I've seen these with round numbers. They'll come to us. I'll look at what the clients had bought, and they'll show me that they've got some universal life policy. Let's say it has a death benefit of $500,000. And I say, I already know that this was not sold to you correctly. How? And I said, because they should have solved for the death benefit amount based on the amount of money that you were willing to put into this so you could max fund it, meaning the death benefit should read a very odd number, like 128,526, because you solve for it instead. That's the reason why I don't like them. They're tricky, right? But they can be used well. And if you really find a good professional. Now, this is the kind of a second part and a tag along to the question that was asked earlier, which is how do you find a good advisor? And I would say that an advisor, would you trust your financial advisor that you pay a retainer or you pay an assets under management fee that is working as your fiduciary to recommend the right insurance policy to you that has no more or no additional financial gain out of you buying the policy? Or do you go to somebody that is selling you the policy? I would argue that the fiduciary may not know as much of the details of the policy because they probably don't go ripping through them like the commissioned advisor or commissioned sales agent would be doing, because they're looking for features and drawbacks and how to answer these things back. Annuities are the same thing. There's two phases in annuities. There's the accumulation phase. The accumulation phase is where you put money into it. You can grow it tax deferred, whether it's a straight interest amount or it's indexed to something or if it's actually variable. And then there's the annuitization phase. And think of it like pensionizing. It's the turning of that lump sum of money or that investment amount of money into a steady stream of income over some period. It could be for life. It could be for a certain period of time, like 5 years, 10 years, 20 years. That's what's called period certain. It could be a mixture of the two. It may be on two lives. It may be the second person to die that will when the payments will finally stop. And what we're doing as advisors, when we look at something like this, I'm looking at the general health of the client, not only their financial health, their actual physical health. And then I start asking them questions, which is, how old were your parents when they passed, or are they still alive? And if they say, oh, they passed at younger ages, I'm thinking, well, the annuity probably isn't the greatest idea here, because ideally you're trying to outlive your money in this case, meaning you're just going to live forever, and the insurance company is in this case going to pick it up and actually have to pay for you to continue to live. And this is the risk to pensions as well. When we have a healthy population, it puts a lot of stress on pensions, including the Social Security system. Well, the annuity companies are looking at this as the exact opposite of a life insurance policy. A life insurance policy is if you die early. An annuity policy is if you live too long. The insurance industry has these actuaries that are in pound out numbers to try to figure out how to be profitable but still offer a benefit that's sellable. Phone lines are open, 979-59-MONEY. I've got Eric. Oh, is Eric still on the line? Eric, are you there?
This is him, yeah.
Oh, okay, great. I'm sorry.
Yeah.
I spoke all that time not realizing you're still there on the line. Another question.
No worries. I had a follow-up question as well. Because I have a little bit of money in some cryptocurrency like XRP and stuff. And okay. I know I have a few friends that, invest in the Trump coin and use meme coins and XRP. So what's your take on, the whole crypto game right now? And is that a good investment?
Well, okay. Your parents used to say, if your friends told you to jump off a cliff, would you jump off the cliff? No. Okay. The answer is we're not going to get our investment advice from our friends. And what I would do is glean that information that they get and then go to somebody like an advisor that can take a look at it. There's nothing wrong with XRP as far as you speculating in it. What I'm more concerned, as we were talking about earlier, was being systematic. So even if you were wrong about XRP and it went to value of zero and you came back and you said, Brian, but I put $100 a month into this for a year and then it went to zero and I'm really not happy about it, I would say, no, you are a complete success because you put the committed amount in every month, even when you saw it was going down. Now, I'm not saying it's great to throw good money after bad. What is great is to actually create a systematic approach. If you think that long-term wise that one of the cryptocurrencies is going to be a great investment for you long-term wise, then I would say go ahead and do it. But I would start to look for diversification when you start seeing amounts of money invested in something that starts to make you a little bit nervous. Like if you've got thousands of dollars into XRP and you're starting to think, oh boy, if it goes down 30% and it starts to concern you, you should probably get rid of some of it and you should probably be diversifying it into other asset classes. But when you're getting started, I just like the idea that you're getting started and moving, starting to do something. That's what do you do for a living, Eric?
I'm a digital marketer. I help people online, build businesses, basically, starting out with nothing. They're brick and mortar. They're not brick and mortar, but they're 9-to-5 workers.
Coach.
Yeah.
You're a coach. You also need to be coached because you know the one thing, the coaching that you give, probably the toughest thing is to get people to actually get started. Is that right?
100%.
Okay, that's it. This is The Real Money Pros. I'll be right back. I am back. This is The Real Money Pros, therealmoneypros.com. We are in a partnership with several different great sponsors, and that's how we are supported here on this program. I'm not selling you annuities. I'm not trying to even sell you financial advice. What I'm trying to give you is a live financial program on the weekends that actually makes sense. I want you to walk away from the program feeling like you learned something or you are better off in some way. I don't want angry people. That's not what I'm looking for. This isn't controversial talk radio. Well, maybe a little bit. I got a question. Meta. So they get sued, New Mexico. This is a jury, 7-week trial, by the way. And a jury found Meta liable for misleading users about platform safety and engaging in unconscionable practices following a 7-week trial. Now, the $375 million, which is a civil penalty, represents a maximum penalty of $5,000 per violation for 75,000 violations identified. Do you think that these companies, these social media companies, have deliberately preyed and are liable? What is your opinion about that? 979-59-MONEY. That's 979-596-6639. When Jeremiah and I were speaking in the last hour, we were talking about these other things that had happened. I mean, you had Monsanto, the Roundup thing. You've got Ford with Pinto. The executives there getting skewered. Ultimately, it's for economic reasons that they had made certain decisions, and curious of where this liability actually ends. I was looking at news stories from the 70s and 80s, and you might remember this, especially if you grew up here, that there was a lot of chatter about how much TV time kids were getting. And it says the TV is a babysitter, and the blindness warnings and commercials, and being obsessed with the advertised toys and creating crazes like Beanie Babies and so on, actually having social impact, influencing how kids played in the playground and what games and characters and all these other kids are mimicking. And then the latchkey generation, where kids came home to an empty house and they watched TV for hours, meaning that was just the social media, I guess, replacement that I had. I was an X-Gen kid, and we had the television. My parents, I think it was a great babysitter for them. For us, it was, now when I see kids watching too much or any of that stuff, you know it as a parent too, that we should be pulling our children away from this. So we know that the social media industry is trying to attract people to use it. And they need to make it more interesting, and it's always got to be impactful or whatever it is. And yeah, these kids are going to get sucked into it. Video games, that's the other one. People glue themselves to that. It's obsessions of any sort. I guess people could say I'm obsessed with things to do in my garage. And it's true. I just do. I probably do too. Well, I know I do too much of it. And but there's times where I actually enjoy it. And it doesn't usually wreck my demeanor. It injures my fingers a lot. I seem to be giving blood on a daily basis here lately as I keep making stuff. But that's all right. 979-59-MONEY. Now, going back to Eric and his call, there was something really significant at the end of that. He says he's a coach for businesses, for business owners. And I said, well, the toughest thing is to try to get them started. And he agreed with that. And I would like to still be able to say, and I'm sure he would agree with this one, which is, and sometimes once they get started, you can watch them make mistakes and allow them to make those mistakes, even though you know that they're mistakes and they're avoidable the whole bit, but you allow them to do it because the most important part is that they got started. We can fix the mistakes or fine-tune things or clean things up a little bit later, but let's just get them started. Now go back to Acorns, like investing. If you use that, I don't know that website. I don't know their service. Please evaluate it before. I'm not paid by them. I just had learned about it, and I saw the success, at least from one friend. I like the concept, but the idea is that you're getting started. Like you actually logged into the website, opened up an account, which might take some time to put in all your data, and you're going to get uncomfortable about having to put in your social. Why do I have to put in my email address and my phone and social and all this other stuff? It's because it's a financial account. It's a custodian that is bound by lots of rules, and they need to get that. But the good news is you get started. 401ks, those of you that have started new jobs and you haven't actually gone in and selected your investments, then you're going to notice that you're invested. You're in some of the investments that just won't do much. It's forced upon the employer to provide those, and then they're going to put your money into that. But you're not taking full advantage of it. Just get started. We can clean up the other stuff later, right? It's like that text message I had from a friend saying, do you think there's anything we can be doing from a tax standpoint? My very first question was, are you using an HSA? And he was, well, no, we haven't funded it yet. And I'm thinking, well, you just got to get started. Now, they are a perfect example, by the way, of a early 40s couple that he was a listener probably 12, 15 years ago. I'm not sure exactly when I first met him. And they just started saving. His wife was ex-military, and they just decided that they wanted to make smart financial moves and not even have like extremely high-paying jobs at the time. I think they now have great-paying jobs, but they saved well over $1 million. And that was just off of advice they picked up on the air. We used to have just like email conversations or meet, but I'm not his advisor. And they did this. They did it on their own, and they're a great example of people who not only got started but just continued it, then created a strategy. And now he's saying, what do we have to do next level? Next level is they need somebody that is going to guide them through a lot more than just the investment world that they have. It's not just protecting their investments or deciding real estate or if it's going to be in IRAs or non-qualified. It doesn't matter. Somebody that is actually going to look at the estate side, the tax side, the big insurance picture as well, and then what their future plans are and start to blend it. If they own businesses, you got to start changing how you hold title on these, your liability coverage. We start looking at even homeowners policies and umbrella policies to make sure that there's general coverage to be able to make sure that we don't dismantle all of that hard work over some silly mistakes, because that is what we can still fix, especially if it's not already happened. And so find that quality advisor that's really well-rounded. Now, they might be hard to find, and I get it. It might be hard to find one that actually has time too. So start looking around. If you have troubles, you can always go to us, therealmoneypros.com, and we will help you find a great advisor in your area. For right now, you can call the program at 979-59-MONEY. Text me, the same number. That's 979-596-6639. But again, 979-59-MONEY seems to be the easy one. Email Brian at therealmoneypros.com. But if you go back to the liability of companies, this is also the reason why many small business owners that have an LLC set up, you actually started filing as your S Corp and you're doing all these things, and eventually you try to sell your business and you find out that the buyer wants to buy your business. They want to buy all the stuff inside your business, and they want to buy your client list, and they want to buy your great name, but they don't want your LLC. They don't want your past liabilities. So think about the past liabilities that were in place for, say, Monsanto before it sold out to, was it the Roundup product went to Bayer? And they don't want the past liability, so they don't buy the shares. There's a lot of tax planning that needs to happen there. You got to figure out how are you going to retire liability, things like that. When you have these large companies like Meta or X, for all that matters, anything publicly traded or not publicly traded, when they start getting sued, you'll start noticing, obviously, the stocks will be pretty volatile, but it's usually on the early onset of the lawsuits when things aren't known. But as this one has gotten drug out for years upon years with Meta, and now the fact that there could be people in every other state and every city, for all that matters, and now comes out of the woodwork, I would expect that there's going to be some sort of a class action lawsuit, and those will be announced, and then it'll continue to go up through the court system, and it's going to take more and more time, but it eventually just becomes baked in to the stock price itself. Meta is a great example of a company that is trying to not become irrelevant like a Xerox or a Kodak became because they were pigeonholed into a single product. And Meta has been trying to diversify their holdings, but they're heavily invested in AI now. That diversification is also going to help the company with these type of lawsuits because it's not only Facebook that Meta owns. They've got WhatsApp. They have, is it Instagram? I think they own Instagram as well. But no, is that Instagram separate? I don't even know. I don't follow all of it. Talking about AI. Let's do it. I'm excited about this industry still. I've been watching a lot about it. It's volatile from an investment standpoint. I had made it sound like it was akin to the internet. And for those of you that grew up in the 70s or 80s, you might remember at the tail end of the 80s, we were hearing. Now, I was finishing high school these years, and I remember watching very little news, but every once in a while I would see some news story talking about the information superhighway and how companies that I didn't know anything about, Microsoft, and maybe I'd heard of Apple a little bit, but not that much, and talking about how these computers are going to talk to each other. I just didn't get it, nor did I care. Some people did. Some people saw it as, oh, this could change commerce. This could be a new way for businesses to communicate or for people. Some people saw it. Early on in the AI thing, we don't see it either. We're not hearing about what the real applications are. If you're thinking about ChatGPT and what it does for you personally, well, that's not where they're making their money. They're getting some monthly subscription fee from you, but the big contracts are going to companies because companies have an obligation to try to become more profitable, and to become more profitable is to change out, become more efficient. Maybe that means that some people are going to be losing jobs. Do you know somebody that has already lost their job due to AI? Is your job at risk of AI? I'd like to hear it. What kind of jobs are those? Because I think many jobs, to include mine, could also be at risk to that industry. I'll be right back.
Pros.
I am back. I am Brian Wiley, therealmoneypros.com, our entire team. You can see us there. If you're curious about what we do, we're actually financial advisors. We have a firm called Tree City Advisors, part of Apollon Wealth Management. We teach people the better buckets, and we actually encourage other advisors to work with clients and use better buckets type planning as well. It's just a visual approach. It's very simple. I explained how we calculate ourselves into those amounts for each bucket a little bit earlier on in the program, and if you happen to have missed that, you go to therealmoneypros.com and catch it. Now, the AI industry, I have been talking about this and reading about it for a couple of years now, but I'm obviously even a little bit late to the game. I didn't realize this, but AI was talked about 30 years ago. I was watching a movie. It was an old movie. It's going to come to me here shortly. Or they started talking about artificial intelligence, and I don't remember it having any sort of an impact. I don't remember even thinking of what AI was. It was just probably some comment in a movie, and it just sailed right past me. At this point, now I'm watching real-world applications. I'll give you an example. So my wife owns a photography business where they take a lot of real estate photos, and they do a lot of color correction and just trying to make, you all know what the photos look like, right? Those are the ones that it just makes the rooms look beautiful and really well lit, and like they're all giant and everything and just perfectly staged. That's what she does. And she had it was a firm that was based out of Thailand, I believe, where they would send their photos, and overnight those people would edit them. So, for example, you see in the houses where the driveway looks wet, but maybe they didn't actually wet it, so it was probably somebody that edited that photo and added that feature, or they make it look like you're looking out the windows and you can see the scenery that you would otherwise see, but maybe the windows are a little too murky, so those get cleaned up. Well, she was paying like 90 cents per photo, and we're talking about a couple dozen for each home and hundreds of these things every night, and the expense is really big. And I asked her about it. I said, are you telling me that there's no AI that can do this yet? She goes, no, there's nothing like that. I said, why don't we train one? Like, why can't we take all your past folders that whatever the photographer submits and then send the one that it was done by the editor and see if the AI can learn the patterns. Like, it saw the input, it saw the notes that the photographer made, and then it sees what the outputs are, and it just starts looking for the trend and then let it have a shot at it. And so she tried it just briefly, probably about 6 months ago. And then about 2 months ago, she got an email from somebody that is offering a full-blown AI editing service that cuts her editing cost down in half. And the results are literally just as good as what the live editor was doing. In fact, she was even thinking that now, she goes, now I'm wondering if maybe those people in Thailand were using AI. Well, now you got to figure by her switching to AI, somebody just lost their job. This is the AI industry, and the AI industry is going to concentrate more and more wealth into fewer hands. So Eric mentioned that earlier. Say the rich get richer and the poor get poorer. And this is one where I'm concerned that some people are just going to be left out. because of not making yourself relevant. I talked about Meta trying to remain relevant. It's the same thing for our workforce and for you, for me included, financial advisor. I mean, think about that. I just gave you an algorithm for the Better Bucket system. I'm pretty sure an AI system should be able to pick that up. The other parts of it is I would imagine that there are going to be some fantastic financial tools available to people that will get more people incentivized to get started. And those will happen, I'm sure, soon. I don't have the energy, honestly, to go through and try to train up some system and make this happen. I'd be happy to give the inputs to somebody that wants to do it. I don't need to be a part of it. I would just like to be able to share some ideas that I have, which is why not have it look at your checking account and all your transactions and start to learn how to categorize things. It should be able to then compare into tax law and make sure that you're taking advantage of things. Should be able to look at past years and see trends that have gone on, ask questions about healthcare plans and things like that. We're not far away from having digital assistants be able to perform that work. From what I understand, some of the biggest hangups with AI is one is there's not enough computing power for the so-called demand that is going to happen. I think it's yet to be actually made, that demand, just yet. I think people are still trying to realize a way to work with this, no different than how it was in the early 90s when, you could go on to World Wide Web or into AOL, America Online, and not really experiencing the full capabilities of what the information superhighway, the internet, was actually all about. That whole application, of course, came later in the decade, and we saw it get too big, too fast. It failed. That was the tech bust that happened. But now look at it. It's matured. Look at Jeff Bezos. He had that idea of Amazon. He was fighting a Barnes & Noble type of a business model where brick and mortar was his focus, and the fact was that he knew that many people that wanted to buy books were willing to also have it shipped to them. And so he created that. Eventually it became Prime. He had to tell I can't even imagine doing this. You have this idea, you get all these people that put in money, and you stand there as the chairman, the president of this company, for 20 years trying to explain the losses that these people have had for 20 years, having to kick more money in, whatever it might be. But boy, it finally worked. I think it's going to be the same thing when you look at artificial intelligence. We're looking at a great new renewing of our whole energy system, how we create power, store it. I think that there's some very healthy things that will come out of this. The good news is it's happening right here in the United States. Last weekend, I was watching Elon Musk talk about his new Terra Fab, which is going to be built somewhere in Texas. Giant, by the way. The amount of square feet was staggering. I'd never even heard of these type of numbers. I think it was like 100 million square feet under roof to create computer chips, to create artificial intelligence computing satellites that will always have sunlight and power and cooling and everything up in space. And he's talking about as many as 1 million of these things. And that's exactly the way that I'm looking at this as well, which is there's a lot of money behind this, creating the demand. I think the demand's going to happen anyway. Look at college students using it for research papers, helping them. In fact, I think in many cases it's been very helpful and not just a way to cheat or get out of things easily, but we are able to access this information and get it very quickly. Jobs, computer programmers, engineers. I would think that construction, I think all those industries from the design standpoint should be also concerned about how they're going to use AI, and people that are in those industries would also be able to try to figure out how they're going to work with it as well and not become irrelevant from it. But as far as investing in it, I don't know which companies. There are so many of them. I would also say that quantum, you should probably be looking at quantum at the same time, but be careful in both of these investments. It's kind of like the 90s where you had hundreds of internet companies come up that were getting all this IPO money, if you remember this, all this investor money coming in, speculating, and only a few of those companies actually survived the shakeout that had happened at the end of the tech bust. And some of those companies have thrived. And in many cases, you've had companies like Apple that had you invested in those, Microsoft, early on. It doesn't matter how many of those lost, because those few that continued on in big ways, Amazon and so on. And you've got a lot of other companies that just simply failed. And that's the same thing with AI right now. I would just caution which ones to invest in. Be careful with the small ones. I think some of the small ones will get gobbled up by the big ones, and some of them themselves will just be priced right out of their industries, just like we saw with internet. Defense, that's another one. This Iran issue is just an issue, but right now the general chat around the world is the geopolitics right now are a lot of governments are spending a lot of money on defense. And so the defense industry right now is thriving. I don't think it's necessarily done. I think that that's got a lot of crossover back into the technology industry, and we're starting to see a blending with that and now into AI. You've heard the news as well, I'm sure on that. But all of that together, I think there's good opportunity. Look at continuing on with oil companies. Right now, the more oil we control, the better that our oil companies are likely to do, especially when we have a large amount of the refining capacity here in the United States. Now, to sum all of this up, when I was saying earlier about getting started, it is, in fact, the toughest part to do for many people. In fact, it happens to be one of the easier things for me to do. I get started, but the problem is that sometimes I don't know when to be done, and then I don't always create the best thing, but I do get started. What does it take to get you started? It might be a visual approach, the better buckets. Go to therealmoneypros.com. It might be a conversation with a financial advisor. It could be a conversation with a friend. It could be you getting online and opening up your first financial account. Or if you're not using an HSA, go to livelyme.com. It's the best HSA platform I've seen. Open your account, fund it, but get started, and then let us know how that worked. Until next week, I'm Brian Wiley. This is The Real Money Pros.